Hey guys, how's it going today? I'm back with a new subject and a new slide, and today we're going to talk about options 101. Most of you must have heard of options, and maybe some of you know a lot about it, and some of you are a little intrigued as to what it is. Well, I decided to just do a little 101. This is not a very detailed not a very detailed video, but it will give you a start and give you an understanding on what options are, and then if you are really interested you can delve deeper into it. And to give you a fact, options is the most traded instrument in the Indian market, and I would say the same for the US markets. So options will constitute a major portion of all trades that happen by the serious traders, by the pro traders. So let's dive into this. So my first take on anything that I do is a tagline, and to me it's a leverage instruments, and like any other weapon, it can cut both ways. Skillfully used can be the best tool in a trader's arsenal. I'm trying to sum it up and it gives you an understanding as to what options can be. Well, I'll introduce myself once again. I'm Manoj Maheshwari. I run a channel called Market Ideas for Profit, and it's full of courses and full of knowledge about what the market, what are the things that you need to look at in the market, and what would give you. It's basically a journey to find your edge, and once you find your edge, then you're on your way to make money. So until you find your edge, you have to keep on studying. But I've been doing it for 8 years. And I'd still say I'm not all through, maybe 50-60%, and there's lots more to learn. But given 8 years and the amount I've learned, I think it's time that I give back something to the people who would be at my stage, probably 1 year, 2 year down the line in their trading journey, and I could help them get where I took 8 years. Probably they could do that in 3 years, 4 years. So that's the intention of these communications that I'm trying to do with these videos. I want to give back, and I want to try and touch people's lives, because I know that a lot of people have touched my lives and they've made my life better by I've just seen their videos, I've heard them, and that makes a huge difference. Well, I run a channel for trade ideas. I curate those ideas, and we try to make money from those ideas in the market, and the intention to share those ideas is to engage with viewers and audience, and go behind the scene and look at how those trade ideas were curated. So you basically take an idea, go back and try and understand how that idea came about in the first place, and that's the best way. So I love to have a practical approach to whatever I do, and I thought this is a good way to take the learning in a quicker way, in a better way. So let's dive in. Welcome back. So like in every class, the first thing that we need to do is to define or give the objectives of what the class is going to be all about. So we're setting up an agenda. So the first thing that we need to know, we need to give you some light on, is what are options, the types of options that exist, the Greeks that you should be knowing around when you do when you play with the options, the correlation with the underlying asset, and then we go on to some option strategies which have been used and settled around by people who have been trading options for a very long time. And then the last one is a section on the quiz, which will help reinforce some understanding of what options are in your mind. So let's start with the first topic, which is a basic idea of what the options are. So if you go by the definition, options are financial derivatives that give the buyer the right but not the obligation to buy or sell an underlying asset at an agreed upon price and date. So what does this mean? Option is a contract between a buyer who buys a contract and a seller who sells that particular contract. Buyer has the right to enforce the contract, but at the end of the contract, if he feels that he doesn't want to exercise it, he can just take the differential and walk away. He doesn't need to exercise that option. Whereas the seller is bound to accept it, and once he has sold it, he will have to deliver on it at the buyer's request. So the buyer and the seller have their relationship bound in that contract. The contract has a stated price, which in the market terms is called the strike price. So that's a price at which both the contracts happen. So that's the price in terms of at a particular, for the underlying asset at a particular time, what is going to be the price of that underlying asset. The bet is about that, so the buyer is predicting a particular price and the seller is saying no, that price is not going to happen. So there are two sides to the coin, and that's the contract. So there's a slated price, which is a strike price, and there's an expiration date, like I told you. So that the price of the option within that period of the contract will go up and down according to the price of the underlying. So it's like, I'll give you an idea. To give you an example, suppose you're going to buy a house. So the guy who wants to sell the house, he is willing to sell the house, but you don't have the money to buy the house right away. So you go and give the guy a token, and you tell him that, look, I will be ready with my money in a month's time, and I will give you a token. So maybe he'll give you 5% of the entire amount, and he'll give you a token of that money, and he will have transacted and agreed upon that at a particular price, at a particular date, he will give the rest of the money and take delivery of the house. Now what happens is, at that particular time, if the price of the house goes up, you will have invested only 5%, but you will get the increment on the entire property, entire 100% of the property price. So that's the advantage. You get to play the entire amount of the property at a fraction of the price. And then if at the end of the tenure, say in this instance, if the property prices fall, the buyer who gave in a token can say that he doesn't want to take delivery, and he forfeits his deposit, his token amount that he gave. So this is the buyer's right. And the seller, if he has gotten into a contract and he has promised that he will deliver the the property at a particular price, at a particular date, he is bound to deliver. He cannot go back on this contract. So that's the difference between a buyer's right and a seller's right. I hope you were able to understand with this little example that I gave you as to what is an option and what are the buyer's rights and what are the seller's rights. Let's get into the next one. Hey there. So in this slide, we'll talk about the type of options. So there are two types of options, the call and the put option. The call option is a bias towards the bullish side, and the put option if you're biased against the bearish side, you would buy the put option. So a call option allows the holder to buy the asset at a certain price within a specific time frame, with a stated time frame. On the contrary, the put option buyer, it allows the holder to sell the asset at a stated price within a specific time frame. So when I gave you the first example in the last chapter where I wanted to buy a house, I was buying a call option. But now let's say we take an example of somebody who is wanting to sell something. So there's this property which I hold, and which is for $1 million rupees, maybe 10 lakhs, and $1 million or $1 million rupees. And I perceive that after a year, the market is going to go down, and the price is going to be 900,000. So how do I go about trying to hedge myself against this risk that I see? What I can do is I can buy a put option from somebody who is willing to hedge against me, and I can bind him to buy my house at say 900,000 or maybe 950,000, because I perceive it will go down to 900. So I can, if I find somebody who's willing to pay me 950,000 for that house a year later, I can buy that contract from him, and he will be bound to buy it from me at 950, and I will have to pay a premium to him for giving me that contract. And somebody who is bullish on the market and he thinks, no, this property is worth 1 million and is not going to go down to 950, what he will do is he will be willing to take that risk, and he will get the premium that I pay him, and he will not have to buy the house if the market price is not 950. So he is predicting an X price, I'm predicting an X price, and on our perception, we are getting into a contract at a particular strike price. I can give you one more example. Say you buy insurance for your car, and in India we pay a yearly insurance, but in the US sometimes you pay a monthly insurance for your car. And suppose the car, say for a year, when you buy it in India, if your car meets with an accident, the insurance company will pay you for the damages that are required to be paid for. But in case there are no damages, you will have still paid the premium, but because the accidents didn't happen, there is no claim that you can make against that insurance company, and insurance company gets to keep that premium. So anybody who is selling an option gets to keep the premium, and anybody who is buying the option has the option of exercising whatever event that they have insured against. I hope you get what I'm trying to say. So we'll try and rephrase this. When I buy a call, I'm acting bullish, and when I sell a put, I can be a buyer of the option and I can be a seller of the option too. So when I buy a call, I'm bullish, and when I sell a put, also I'm bullish, because I'm not expecting the price to go down. I'm expecting the price to either remain where it is or it to appreciate. Whereas when I buy a put and when I sell a call, I am predicting that the price is either going to go down or it's going to remain the same. So there are 4 ways an option trader can trade. He can either buy a call or sell a put. Now you will say, why do we have 2 ways of being bullish and 2 ways of being bearish? Well, once we get into more detail, which is a detailed subject, you will get to know what are the difference between being bullish, between buying a call and selling a put. There is a difference, and I can tell you that when you buy a call, you will only make money if the price goes up and meets your target within that specific time. But when you sell a put, even if the price doesn't go up, price stays where it is, by the time the contract is live, you will still get to pocket the premium that you received when you sold something. So this is the difference between buying and selling. So buying is a lottery and selling is like acting like an insurance agent. I hope you get it. These are the ways the option market operates. So option allows a trader to hold a leveraged position at a fraction of the cost of the entire property. So entire value of the stock. So like I gave you the option in terms of when you buy it, you're holding the entire property's value, which say 5% of the investment that you made, and within that specified period, if the price escalates, you get to keep the escalation on the entire 100% of the markup, but you end up only having paid 5%. So up to 5%, you will have not made any money, you will not have lost anything, but anything above 5% is going to be your profit. So that's how the option markets operate. It is used by traders. It's also used by investors. If I want to predict something a year down the line, 2 years down the line, I can play options as an investor too. But in India, we don't have such depth in operation in the options market for higher time frames. In US, you have liquidity for 2 years, 3 years also in certain stocks, not in all of them, but in certain stocks. So that's the kind of type of options that we have, and this is how it opens a whole new ball game for you to leverage your money and play the market. So it's used by traders to increase a higher ROI over the invested amount of money. So that basically it's a leverage product, and you bet on that leverage, and it's like a bet. You can't say it's gamble. It's like a bet, and there are strategies which help you make money with a lower amount of risk too. So you'll get to know more about it as we go detailed into this subject. So let's hop on to the next one now. So when you trade in options, there is the market, or there is a way to keep track of the number of options that are there in the market. So to keep track of all the strike prices and all the prevailing prices of the puts and the calls of that strike price on a given date is quite a challenge. So if something is ruling at say 100 rupees today, so the strike prices will be 105, 110, 115, 120, 130, 135. So these are the strike prices which the exchange will open. So each strike price will have a put and will have a call, and each put will have a certain value and each call will have a certain value. And then you also have to keep a measure of what's happening on the put and the call on a daily basis. So to record all that data based on the strike price and the price movement of the underlying, which is the actual stock, the prices move on a daily basis. So at the end of the day, or even concurrently, as the price fluctuates within that day, the price is recorded on a chart, on a table, and that table is called the option chain. So we need to understand what an option chain is. So option chain is a table displaying option codes for a particular underlying security in the real time. And as the exchange closes, that becomes the end of the day's time. but as the exchange is live, the option prices keep on fluctuating according to the price of the stock, also which that fluctuates within the day. So the option chain matrix is updated in real time, like I told you, and it also talks about the volume of what each option contract has played and the best bid and offer. So like you have in stocks, there's a bid and offer, and that also keeps on being recorded on the option chain. It is also used to identify unusual activity. If somebody has got some inside information, or if he suddenly takes a call that the price is going to be an X, he will try to play the market by buying a huge number of options in that particular contract. Now once that is done, it reveals to the market that there is somebody, not knowing who it is, there is somebody who is predicting that market is going to go into an X level, and that shows buyer interest. So that's called the open interest, because there's somebody who's predicting that the price is going to this level, and if he has inside information, the market tends to believe that it can happen. So the volume plays a very important aspect in when you scan the chart and you see where the volumes are, the probability of that price getting struck in that particular time frame becomes a high probability event. So that's how option chain helps you to get a bias on where the market is going to go. It may not be right all the time, but volume plays a very important price when you talk about technical analysis. So price and volume, these are the two major things that move the market, and when you align them is when you get to get an idea as to what's happening at a particular price point, and that's where your support and resistances are. So the option chain basically helps you to find the support and resistances in a way. There are people who would find support and resistance by looking at the chart, and there are some people who will find support and resistance by just studying the option open interest, which is this is the open interest. So there are people who bet against it, and there are people who have played against it, and probably it happens at a particular strike price, and those prices are important points where people are laying their bets at. So that's called the open interest. Option chain, like I told you, it gives you resistances and supports, and then there's one more important important matrix, which is called the Greeks. Now I'll talk about it in the next chapter, but option chain also, one part of the option chain also holds values of all those Greeks over that period. So we'll talk about the Greeks later, but the Greeks are also displayed in the option chain. We'll get to it in the next chapter. Let's go about and go to the next one. Hey there. So this is an example of an option chain. So what do we have here? So I'll just use a pen to explain to you. These are the strike prices that we were talking about. These are the strike prices. Now this is called the ATM, at the money. Basically what this means is that the current price is somewhere around 17,500. Anything on the call side above 17,500 is shaded this way. Anything on the put side is shaded this way. This tries to tell you where the price is. So these are the strike prices, and these are the quantities that are being last traded. This is the bid quantity, this is the ask quantity, and then these are the prices at which the transaction is. So the difference between 155 and 158 is called the spread. This is the bid quantity, and this is the ask quantity. And then I spoke about volume. These are the volumes that show what is the volume that has been traded in the day. This is the change in open interest that has happened within the day, and this is the actual open interest. So if you look at it, there are 13,400 contracts which are alive, and this is 90,000. So when you scan the entire open interest, that tells you where the resistance and support could be. Similarly, on this side there is open interest, and that is the change in open interest through the day. This is the volume of contracts that got transacted on that particular day. And then there is an important element called IV. Now what IV says, it talks about the implied volatility in the market. Now implied volatility is a measure of the sentiment in the market, whether it's bullish or bearish. The higher the IV, there's some major event that is going to happen in the market, and that's when the market becomes alive, and that is a factor of the IV. Now you don't see Greeks on this chart here. Well, there's not enough place to display the Greeks because there are so many metrics, but a second look at an option chart will show you the Greeks in the next one. So this is a very good example of an option chart. Obviously it's a big subject to study. I'm just giving you a brief overview, and we can go in depth and we can spend 1 hour to discuss just the option chart, and but I'm giving you a brief overview here. So that's about it. Let's talk about the Greeks in the next chapter. Let's talk about Greeks. Now, Greeks is a it's a very diverse subject, and explaining to you about Greeks in a very short span of time, like I'm trying to do in this slide, is not easy. But I'll give you a brief overview. So, what are Greeks? Greeks are financial measures of the sensitivity of an option's price to its underlying, determining parameter. So, say if I'm talking about a particular asset, and the price of that asset will fluctuate up and down. Now, based on that asset, the option price is also going to fluctuate up and down, because as the price goes up, the price of the call will go up and the price of the put will go down, because the call is positively correlated and the put is inversely correlated. But the option price is also determined by these Greeks. These Greeks also, will the price of the option is not going to move exactly in the proportion of the price movement of the stock. So if the price of the stock is moving by 1 rupee, and a strike price at the money, which is at a similar price as the option strike price, will move half. So that's called the delta. Delta is the rate of change of the underlying and the rate of change of the option price in relation to that change in the underlying price. So that's what delta will give you. Similarly, theta will tell you how much is going to be the decay of that option price, because theta talks about the tenure of the contract. So as the tenure keeps getting closer, the theta depreciation becomes lower. So the theta will give you the decay. The amount of decay that's going to happen is controlled by the theta. The gamma will display the rate of change of the price in relation to a change in the delta. Vega will talk about the rate of change of the implied volatility, and rho will talk about the interest prevalent in the market. So it's a very detailed subject. It's not my intention to explain the Greeks to you in this slide, but I will go to introducing them to what Greeks are. And the major Greeks that we need to look at are delta and theta. These are the two Greeks that will affect the price of the option based on the movement in the underlying and the tenure of the contract. How close the tenure is to the expiry, how close the strike price is to the real price. These are the two things that the traders really have to keep on looking at before they take a decision to buy and sell. So option Greeks are financial measures, like I told you. The Greeks are utilized in the analysis of an option portfolio and in sensitivity analysis of an option. Option Greeks refer to delta, gamma, vega, theta, and rho, like I showed you in this caption. For each option contract, they vary based on the strike price and the market volatility, taking the expiry date too as a factor. Greeks studied in combination help in mitigating the risk of losses, as you can predict the nature of price sensitivity to the underlying. So Greeks help you in predicting, given the same price, what is going to happen to the option price at a given point of time. If the price is same, or the theta will cause erosion of the option price, even if the price is remaining the same, because the option price has got two elements. One is the intrinsic value, one is the extrinsic value. Again, I'm using these terms, and you will have to study it in detail about a lot of these things. So options is a very detailed subject, and it probably take me an hour to discuss just one aspect of a Greek. So here I'm trying to give you an overview, but these are the things that you need to look at when you start playing the options game. We'll get into the next one. Hi there. So in any case, I gave a lot of weightage to this particular slide, and this is a very important subject in every activity that you do in the market. So risk management, I've spoken about it in various other chapters also when I discuss about things that are important to look at in the market, and risk management is a very important subject to look at when you trade into options, and more so when you deal in a leverage product. Risk becomes all the more important to be aware of, and knowing what your risk is the entire ball game. So you can limit your risk in a trade by buying a lottery. When you buy a lottery, all that you risk is the amount of money you took to buy the lottery. So options give you an opportunity to play a leverage product with a defined risk. But when you sell a particular option, the risk becomes indefined and becomes to infinity. But in real ways, it is not infinite, and there are strategies to limit your risk also when you sell. But in combination of buy and purchase of options, you can limit your risk. But given just the play of call and a put, call gives you a limited risk and a infinite upside, and put selling a call gives you a limited amount of money that you can make as a premium, but it exposes you to unlimited risk. So risk management is a very important thing that you need to consider when you get into options. So again, you can play stop losses in options also, like you play in trading in stocks, and maintaining both short interest and long interest in a particular commodity is a kind of a strategy where you can buy an option and sell an option at a higher level or at a lower level, and you can control your risk and you can cap your upside. And these are strategies which you can play with, and then all profits at the end of the day, they are the fruit of managing your risk. So in the market, you're playing with probabilities, and risk is a part of the game. So in the end, if your way to assess the price direction is good, and if you manage to predict the price direction in a more consistent way, and then you learn how to manage your risk, most of the time you'll not lose in the market. So there are two major things. One, you have to predict the price direction, and second, you need to learn to manage your risk. If you learn these two things and you can identify the entry points and the exit points, that's all the market is all about. I may be sounding very simple, but when you talk about analysis and when you talk about reading the market, these are the two important things. And like I've told you before in the other chapters, it's not about just analyzing. It's also about psychology. When you see green on the screen, how you react. When you see red on the screen, how you react. And psychology plays a very major part in the stock market. So risk management, I will try to stress upon it in every subject that I take up. Risk management is very important when you play the options also. Let's go to the next one. Option strategies. Well, it gets interesting by the explanation that I gave you. Now there are strategies in options, and there are combinations that people have worked out, and there are a number of ways how you can trade in options. So there are certain strategies which allow you to play the options and limit your risk, and there are certain ways where you make a strategy that the price is going to remain between a band. So let's say the price of the current underlying is 100, and I want to play a situation where I want to say within a month's time the price is going to remain between 115 and say 95. All that I need to do is make a strategy where price has to remain within these two ranges, and I'll still make money. So how do you do that? By buying an option and selling a counter option with a different strike price. So these are strategies which allow you to even make money when the prices remain within a range. So in a normal parlance, if you buy a stock, you make money only if the price moves up. But when you play options, it gives you an opportunity to predict that the price is going to remain within a range, and I'll make money. So I can give an example where if I have to say a price of the underlying is 100, and I'm predicting that it will not go below 95. Well, even if it remains at 96 at the end of expiry, I'm going to make money. Even if it stays at 95, I'm going to make money. Even if it stays above 95, I'm going to make money. I'm only going to lose money if it goes below 95. So option allows you to create these kind of strategies where the returns get lower, but there's more predictability and consistency to how you can predict the market. If you get me right, what I'm trying to say is that in a scenario where you buy a stock, the only way you make money is when the price goes up. But when you trade in options, you can make money even if the price remains constant, or it doesn't go below a threshold, or it doesn't go above a threshold. You can predict all those, and you can play the market by just predicting the levels, and you can make money in options. Now, how cool is that? We can't do that with just buying buying a stock and not having to make money. We won't make money. The stock just stays where it is. But in options, even when the price doesn't move, you make money. And you can just predict a level that can't be reached, and you can make money. Now, doesn't that make life much simpler? Well, to achieve that, you need to understand and you need to risk. But that is a door that the option strategies open to you. And there are a number of strategies, and there are a number of people who combine the buying and selling of puts and create their own strategies. There are ways about doing it. They can buy at certain strike prices, and they can also vary their tenures. So, there are a number of combinations that you can make by combining a number of options and getting into a trade. So these are the option strategies that we can talk about. So you can long a call or a put, and then you can also sell a long. You can sell a long out of the call. You can sell a call out of the money, and I can talk about those strategies. But there are so many that I can't cover it in this subject. But I've told you the gist. Option allows you to make money even if the market doesn't move, or option allows you to make a threshold, and if the threshold is not reached, even then you would make money. So option opens up a lot of possibilities of trading in the market, and those option strategies are too many, and you can design your own if you are inventive about them, and you can follow the ones that are already there in the market. So that's about introducing to the option strategies, and the gist is that it opens a whole lot of possibilities of playing the options market and making money in the market. So with that, I think we will have completed this lesson, and we will move on to the quiz section in the next one. Welcome to the last part of this section, and we call it the quiz. What I'm trying to do here is trying to find whether you have got a grasp of what I was trying to explain to you. Well, you may not have. I may not have done a good job, or you may not have been attentive enough, and that's the beauty of this video. You can go back and see the video again, and probably after seeing the quiz you will get a better understanding. So here goes. The first question that I ask of you is, does an option buyer have to exercise his option? It is a simple yes or a no, and all I expect you to is to choose one. Here goes. 1, 2, 3, 4, 5. You made your choice. Let's get to see the answer. The answer is no. A buyer of an option doesn't have to exercise his option. He has the liberty to do it or not. So the seller is bound by it, but the buyer has the right to exercise it or to rescind it. He has the liberty to exercise his option right, or he can just leave it and the way it is. But the seller cannot do it. So that's your quiz. Quiz number 2 is, what is the option chain? It's a table with all relevant option information. It's an indicator, or it's an option strategy. We've gone through this. You can go back and recollect what was an option chain. What was it all about? Here goes. I'll give you 5 seconds. And the time stops now. You made your choice? Well, let's see what the answer is. It's a table with all the relevant option information. Like I told you, it contains the bid and ask, volume, the open interest, and at times the Greeks too. So if you haven't understood, go back to the subject and you'll get some more detail on it. Let's get to quest 3. What is a long call? It's an undefined risk strategy. It's a undefined profit strategy, or is a defined risk strategy. Now, these are the three options that you have. I gave you a lesson on risk management, and I gave you a very beautiful description of what the options allow you to do. So you got to choose one of these 3, and I give you 5 seconds. 1, 2, 3, 4, 5. Have you got it? Well, let's get to the answer. And here goes. The answer is a defined risk strategy. When you buy a call or when you buy a put, the amount of money that you pay as a premium is all the risk that you take. So that's a defined risk strategy. You're predicting a price in a particular length of time and you pay a premium. You cannot lose beyond the premium that you paid. So that's a defined risk strategy. It is like buying a lottery. You buy the lottery and you pay the price of the lottery. Doesn't work? Fine, you didn't make it. But there's no loss beyond the price of the lottery that you invested in. So that's the long call. It's a defined risk strategy. Let's go to quiz 4. What is an undefined risk strategy? A strategy with unlimited risk, a strategy with limited risk, or a strategy with no risk? We've spoken about this too. And you get your 5 seconds here. 1, 2, 3, 4, 5. Let's see the answer. I already explained it to you. I hope you got it. If you didn't, you can always go back. Well, it's a strategy with an unlimited risk. Unlimited risk means if you sell a call or if you sell a put, you get the premium. But if the price goes against you, it can go to the moon, and every time it goes higher beyond the threshold that is the strike price, you will start losing money. You are hedged only to the extent of the premium you collected. Once it surpasses the amount of the strike price and the premium that you earned, then you have unlimited risk. Well, nothing to worry. There are ways to control your risk also using strategies, but an undefined strategy is something where you expose yourself to unlimited risk and you're happy with the premium that you collect as all the profit that you can make from that strategy. Well, probably the last one. Select the option that would profit from a rise in the price. So these are 4 options. You are bullish in the market. What would you do? Like I told you, there are 4 ways to play the market, and these are the ways you can do. So what are the ways where you can profit from a rise in the market if the market is bullish? What activity would you do amongst these 4 which would give you profits? Now remember, I told you you can be 2 ways bullish and 2 ways bearish. So I'm giving you a hint here. There could be 2 answers out of the 4 that can give you a profit when the prices rise. And there goes 1, 2, 3, 4, 5, and now you have the answers. Well, you short a put and you long a call. These are 2 bullish strategies, and on the contrary, shorting a call and longing a put are 2 bearish strategies. There you get it. I hope you get it, because if you get it, I've done a good job. If you didn't get it, you have to look at the video again. Let's go with the next one if there's any. Or there goes. We have 5, and you can do your own assessment of the score you gained. If you didn't, you'll need to go back to the video again. I have explained everything that I raised in the quiz, and not difficult. You will be able to. These are the basics of options, and if you like the subject and if you like the probabilities that you can get with the options, it opens a whole gamut of things that you can do with the market. And believe me, it gets interesting if you get into the options. Playing the stock route is not that interesting. Playing the options route, man, it changes the game, and it is a whole new ball game. I'll encourage you to learn more about options. If you really want to become a pro trader, you've got to trade the market with options. Options are not available for all the stocks, and generally the stock market, the exchange will only release options where there's enough liquidity of buyers and sellers with active interest in that stock. So these are called FNO stocks in the Indian parlance. In the US also, not all stocks have these, but wherever there is a huge buyer and a seller interest in any stocks, the natural progression is to have an options market for that. Well, so we have come to the conclusion of this chapter. I'd like to reintroduce myself and remind you, this is Manoj Maheshwari. I'm a certified technical analyst with an experience of over 8 years. I've been in the market and done all of it. Have suffered losses, have made money, and become more consistent over a period of time. And this is my giveaway back to what I have learned in the market and communicating with you. The intent is to, hasten your journey to where I am. And what else? I run a channel called Market Ideas for Profit. What we do there is, it's a premium channel. You have to, pay something to get value out of it, which is fair. If you appreciate the understanding that I bring to you. And what I do there is I release trade ideas, and we can trade those ideas in the market with concurrence of your financial advisor, and with your risk ability and your intention to exercise your option to take those ideas or not. It's an open understanding between you and me that I am not certified person who can give you a plan, who can plan for you, but I give these ideas with the intent of you seeing the ideas, and then we go back and at times study the curation of those ideas. So that gives you an understanding how those ideas came into being, what analysis I did, and what made me believe that these are the thresholds, or these are the ranges, or this is the price moment and the momentum that is going to happen in the market. So it helps you explain the process as to how those ideas got curated, and over a period of time that gives you that education to build those ideas on your own. So I believe in being practical, and it's all that I show in my videos. I give you the idea, and then I go back and curate, help the curation process, and you can come back and talk to me and ask me how it was done and why would I do it, what was the analysis that led to that idea. So that's the entire activity that we do. You can visit me on my website where we have listed the courses, and I blog over there, and I release my ideas also, and then I go out to the world and express myself in what I feel by using the Twitter handle, which is Hey Manoj. So it's been nice spending this time together. I hope I've given you some gist of the options basics. It's just a one-on-one. It's not a detailed subject, but I've given you some basics, and we can expand on that. We can get again together. You can do more research, and I wish you all the best. And I encourage you to learn the options, because that's the real way to play the market. That's the key to becoming a pro. All the best. Until we see again. Ciao. Goodbye.